Hello, accounting students. This is Mrs. Lanphier, and we are looking at Unit 4 in this video, Sections 1 and 2. So in Section 1, you just kind of briefly go over what we've been talking about. So in the previous section, we talked about accounting transactions, the accounting equation, asset equals liabilities plus owner's equity, the double entry system, how with every debit we need a credit, and business transactions and the importance of recording those, and so on and so forth. So in this section, we're going to learn about the accounting cycle and steps to record a journal transaction. So a couple different terms so far. The accounting cycle, we talked about the accounting cycle a little bit already and how it can be different for each business. But most businesses have like a yearly cycle called a fiscal year. And we're going to look at, and we also talked about closing accounts at the end of the fiscal year. We talked about permanent accounts and temporary accounts. So we're going to be kind of putting more of that together during this, during the next couple sections. And then we're also going to officially record journal transactions. So we've been analyzing transactions, and now we're going to actually record it into a journal. So let's get started looking at Section 2. All right, Section 2, recording transactions in a general journal. So businesses maintain their accounts to no profit or loss. We talked about this before, incurred during a period, so a period of time. Maintaining accounts involves entering into the business transaction, collecting and verifying the sources of documents. So we're going to talk about different sources of documents in the next couple pages, and then analyzing each transaction and entering it into the journal under the double entry system. So we've already been doing this, analyzing business transactions. That's where we've been determining what accounts are being affected. We've been determining if they're going to increase or decrease and whether that's a debit or a credit. So that's nothing new. So the only thing we're going to start doing differently is instead of recording them in T accounts, now we're going to practice actually logging them into a general journal. So when people keep their accounting books and they record all their information, they record it in what's called a journal. And so and then they write every transaction down in the pages of the journal so that they can go back through and see exactly what happened with every transaction, which account was being debited, which account was being credited, and so on. So here's a video that just kind of shows you, this is just a business transaction. So money paid for the material, material received, then a receipt for the transaction, and then logging that transaction into the journal. That's what this last image is here. So we're going to, again, kind of go over and go through lots of different examples about recording transactions in a journal. So this is just a highlight of what we're going to be talking about in this section. We're going to talk about the first 3 steps of the accounting cycle. We're going to talk about several examples of source documents, so like receipts, invoices, so on. Explain the purpose of journalizing. Apply information from source documents. So what does this receipt exactly tell us? The steps to make a journal entry, correcting errors in a journal, and then we're going to look at some definitions of some of the accounting terms we're going to be using. So let's get started. First of all, the accounting cycle has 9 steps. So throughout the course of the accounting year, we're going to be going through all of these 9 steps, and some of those steps several times. So there are 9 steps in the accounting cycle. They are identifying transactions, analyzing transactions. We've already done these things. Okay, so we should already be familiar with those first 2 steps. Today we're going to introduce source documents and talk about those. Journalizing transactions, we're going to cover that today. And then later on we're going to talk about posting journal entries to a ledger, preparing a worksheet, a trial balance, financial statements, closing entries, and post-closing trial balance. So today we're going to look at these first 3 steps, but we will be covering all 9 throughout the course. Okay, so step one, identifying transactions and verifying sources of documents. That's just fancy language for, okay, what happened and what documentation do we have for what happened? So we've talked about business transactions and how they take place every single day. For everything from payment of rent, electricity bills, purchase of machinery and materials, sale of goods. So we record and track all these transactions in order to make sure our business is financially sound and staying on track. Every business transaction must have a source document as verification of the transaction. So you guys see these every day. When you go and buy something and you get a receipt in return, that is a source document verifying the transaction that just took place. We're going to go over other different types of source documents. Here's some examples. So we have an invoice. An invoice is a document that provides details about buying or selling materials or goods. The invoice is made for purchasing materials or goods, known as purchase invoice. So similarly, an invoice is made for the sale of material or goods, known as a sales invoice. So sometimes if a company purchases material from another business, they might put together a purchase invoice as documentation, or if you sold materials to another company, you might create a sales invoice indicating the sale and documenting that. The invoice contains the name of the purchaser, terms of purchase or sale, details, quantity, and cost. So the invoice is going to contain what was bought, what was sold, a list of all the materials involved, how much of it was bought, how much it cost, total price, the date, and any other, whether or not cash was paid, credit was paid, check was paid, whatever payment details they can record. So that is an invoice. A receipt is given when a customer uses cash. A receipt is used as an acknowledgement for having received payment. So like I said, it's when you go and buy something from the store, you get a receipt, and that shows that you made the payment and the transaction has been completed. This is called a cash receipt. The receipt contains details such as date, payment amount, customer's name, and nature of payments, whether it was cash, credit, check. Usually that's kind of included on the receipt. A memorandum or a memo is prepared when there is no evidence of a source document for a business transaction. So maybe there wasn't a receipt or there wasn't an invoice. So a memo is something that's created and considered as the source document for the transaction. Okay, and so this is just a brief message about what went down. So maybe it was more of a casual exchange of money and items, and so a formal receipt or an invite wasn't created, but you need to create something. Okay, so and that's where a memo would come in. Okay, and then we also have check stubs to verify as a source document. So when a transaction is made through a bank, you use checks to transfer money to the client. To know the balance amount in the account as evidence of payment, the details are entered into the counterfoil of the check. Oh gosh, this is fancy language. This is called a check stub. So again, just like the other sources, it lists the same information, date, who it was made out to, the amount that it was made, the balance of the amount available in the bank after each check is written. So a check stub can also be used as a source document. Okay, moving on. Okay, so that was step one. So we identified the transaction and verified sources of documents. So we know that we need to have a document or a source for each transaction that our business has. So after we've collected and verified the source of documents, the next step is to analyze the transactions. You can analyze transactions by applying the rules of debit and credit, so what we've already done, to the transaction. While analyzing the description of transactions such as John Carriage Service bought a computer system from Infosystem Incorporated for $2,000 and issued check number 210 as payment. So if you're analyzing a transaction and that information is not given, you must examine the source document to determine what occurred during the business transaction. So Sometimes not all of this information is going to be available to you, so instead you need to check the check stub or the memo or the receipt and determine all of this stuff for yourself. It's not always going to be written out for you. Okay, so then analyzing transactions. So we look at our source document and figure out exactly what transaction took place. That was step 2. Now step 3, we're going to journalize each transaction. So after we analyze the transaction, we need to consider the effect the transaction has on each of the accounts. So again, something we've done before. This effect is then recorded in a chronological journal, and this record of the transaction under the double entries system is called a journal entry. Okay, the process of recording a business transaction in a journal is called generalizing. So again, just new terms being thrown at you. So when we record these transactions and we write them down on paper and make them official, that's called journalizing. All right. So we need to ensure that every journal entry is recorded both in the debit and as well as the credit, as the journal entry is the first and most basic record in an accounting system. So this is the first and most basic record in an accounting system. So just like we did in our T accounts, we need to always have a debit and a credit that equal in our journal entry. Okay, the accounting period. So all accounts are summarized for a particular period. This is information we've covered before too. So the duration for summarization of accounts is based on the discretion of the business persons. Okay, so basically that says whoever the business owner is, it's up to them to decide if they want to do monthly or quarterly or yearly summarization of their accounts. Most businesses do close their accounts annually though. So they look at their, like we said, an accounting cycle or a fiscal year is what most businesses use. Again, the 12-month period is called a fiscal year. But businesses can also kind of arrange these fiscal years differently. It can go from January 1st to December 31st, kind of your typical calendar year. A lot of department stores follow February 1st to January 31st to really get in on all of that Christmas action. And as educational institutions follow July 1st to June 30th, because like schools starting in August and ending in May, this fiscal year period fits their business better. So again, depending on the type of business you have, you can adjust that fiscal year. Okay, these are some practice activities that you should complete on your own. Test your skills and check your answers to see if you are correct. And now we're going to talk about journalizing. All right, so we talked about the main transactions that take place and that they need to be recorded and journalized in chronological order. So that means in order of the date that they took place. Okay, so we want to make sure that we don't have a bunch of different transactions like bouncing back and forth from one week to the next. We want to keep them in order from the date that they took place. There are different kinds of accounting journals in business, but we're going to look at a general journal format. And this is what the general journal format looks like, okay? You have your date, the account title that's being affected, the amount that's being debited, the amount that's being credited, and then kind of the information to help you out. So the debit or credit account will go in this space here. You always want to list your debit first, okay? So this is one transaction taking up 3 lines in our journal. We always list the debit first and record the debit amount, then we list the credit and the credit amount, and then the source document detail. So you want to say check number 101, receipt number 5, memo number 6, whatever source document you have will go in this 3rd line here. Okay, steps to journalizing the business transaction. Luckily, we've already covered the first 3 of these 4 steps to journalizing in the previous videos in Unit 3. So, analyzing the transaction, thinking about what accounts are being affected and how, applying the rules of debit and credit, that's kind of the how part. Are they increasing or decreasing? Is it going on the debit side or the credit side? Preparing a T account, and then passing it in a journal entry. So passing a journal entry just means to record it into your journal. Analyzing. The process of analyzing consists of following steps. So like we've done before, identifying the transaction and the accounts that are being affected. Are these accounts assets, liabilities, or owner's equity? If it's owner's equity, is it a revenue withdrawal or expense account? There it is. I couldn't think of that third one. Okay, determining the amount by which the accounts should be increased or decreased. So we've done all of this before. And we've done this. Apply the rules of debit and credit. Is the account going to be debited, going to be credited, and follow the rules of debit and credit. So we know the rules. We know how to name our accounts. We've done this stuff before. So now we're just going to put it into action. So again, do this practice activity on page 12 on your own to kind of test. It's a good little checkpoint for you. Again, on page 13 as well. Okay, so on page 14, we're going to start in on some examples, and I'm actually going to stop this video now and do a second video going over all of these examples.